everybody, what's up? We are back with another stock analysis. Today we will be looking at Google. So Google has been trending a lot recently. I've never reviewed them on the channel. Obviously, everybody knows what Google is. I have looked into the stock before, but I never actually specifically reviewed them on the channel. So that is what we're going to do today. Financial analysis, going through the earnings a little bit, their chart, as well as doing a bit of my own kind of a valuation. So if you're interested, make sure to subscribe. I make these videos every single day of the week, and let's get into Google. So getting into Google, I really don't think I need to do much of an introduction. They do everything related to software, cloud products, online services, whatever. They do everything. And also, yeah, that's all. So first off, $2.2 trillion company with a very, very low dividend yield of 0.4%. We are looking at a target price currently of 220 and a long-term growth rate of just over 8%. Right now we are at 185, so they are expecting a very significant amount of upside with the company currently, which is definitely interesting. Just considering how much they are worth. But honestly, I'm surprised Google isn't worth more. Looking at their growth summary here, positive across the board with everything. Very, very solid sales growth, very, very solid cash flow growth. That's all you really need to see here. Everything else being positive is very good as well. So let's continue through this, starting off with the income statement. Let's see how they've been doing recently. So first of all, let's go into the years. Hopefully they have 2024, which they do. So earnings growth as of recently has looked pretty solid for the company. Basically gaining 50 billion more in sales in the past year. That is insane. Net income is at an all-time high and has been growing very consistently every single year. Operating income, same thing, at a very significant all-time high. Also, their margins here are insane. They have close to a 30% margin, probably around 27% of their sales are profit, which is crazy. Also, total shares have been falling very quickly. Looks like they're averaging right around 200 to 400 million shares being repurchased every year, which is insane. But for an investor, that is amazing. And it looks like they've been doing that roughly for the past 5 or 6 years. So that is awesome. Other than that, let's get into the balance sheet and see what's going on here. So assets, of course, have seen massive growth. They have $95 billion in cash, which is insane. Short-term debt, long-term debt is very minimal compared to how much cash they have. However, they still do have just under $30 billion in total debt, so that is something to consider. But overall, they have so much cash that it really is mostly meaningless. Moving on to the cash flows, let's see what we have going on here. So operating cash flows, again, are at an all-time high in 2024. That is fantastic growth we've seen over the past 2-3 years, which is unprecedented, but also very good. They have been selling off a lot of assets over the past few years, which isn't necessarily a bad thing, but it is just something to note. But again, record profits, probably record margins too. So realistically, this does not matter at all. Dividends paid, we see that as well. Changing capital stock, again, they have been putting billions and billions of dollars into repurchasing their own stock, which is amazing. Very little debt issuance recently, a decent amount of repayment as well. And overall free cash flow is also seeing an all-time high, which is fantastic. Let's get into the ratios now and see what we're looking at. So margins, again, are fantastic for this company. So first off, gross margin is at 58, above their 5-year average and on the higher end of what we've been seeing recently overall. Net margin is at 28.6%. That is fantastic. Considering they're at record sales, this really shouldn't be the case for what we're seeing here, but it is, which is amazing. And also scrolling down here, debt to equity ratio is very low, under 10%. There is no struggle whatsoever with their debt. So let's move on to see if we could find any earnings here. Which of course we will be able to. First off, let's just go into the metrics recap and see what we've been dealing with. So revenue beat fairly significantly, about 300 million over for Google services. Cloud came in a little bit below. Other than that, other came in significantly below. Let's see, net revenue came in right about in line, slightly below. Operating income came in above. Margins also came in above of gross revenue, 32.1%, of net revenue, 38%. So overall looks pretty good there. Free cash flow did come in below estimates, unfortunately, but overall looks very solid, I would say. This isn't necessarily a massive outperformance, which if we go and see what happened with their stock price, we can see probably wasn't anything crazy. And no, they actually went down. So one thing I would say with this is what most likely happened was it is a solid report, but there wasn't any significant outperformance on any metric that we really saw here. Margins were pretty good. Their main revenue source outperformed slightly, which is good, but some other thing lagged. So overall, more of a mixed earnings report. Additional metrics we can also see. Let's see what this says. So I have no clue. All right. Anyway, on to street takeaways. Let's see what analysts have said about why it went down, hopefully. So if you would like to read through all of this, by all means, go ahead and pause here. But I'm just going to read what this says here. So generally credited the cloud miss and higher than expected 2025 CapEx impacting shares in spite of better growth in search and YouTube. Capacity constraints pointing to impacting cloud results seen to ease moving ahead, which is good. Higher capex was viewed more mixed as some see investor hesitancy around the increased investment for search, while others struck a more upbeat tone around the outlook for continued health in the ad environment with solid share persisting. So again, like I was saying, it is mixed. Revenue was up 11.8%. EPS beat. Advertising was up. Gap margin was up 460 points year over year, which is fantastic. Also beat. So overall, I would say this is a good report, but it did not really impress investors too much. So saying that, let's move into a valuation now and see what we could find. So first of all, if it actually wants to give me some good competitors for them, which it is, of course, and so what we're seeing is with all of these companies here, average PE ratio is 33.69, median is 35.46. So let's just get Google in here and we will put in their numbers. So 33.69 and 35.46 and 35.46. So based on this valuation with all of their competitors, that includes Apple, Nvidia, Microsoft, based on all of these, we are seeing a valuation for Google of around $266 a share with a 42% upside. So overall, I think Google is probably one of the most undervalued mega cap companies. And in my opinion, it probably should be much larger either way because Google really does do everything and they do everything very well. I'm using a Google application to show you this. I'm using Google's browser to show you this. Overall, I think there's just a ton of potential. And even just looking at the stock growth recently, even with all of this growth that we've been seeing in the past, let's just go to the past year, they've had a very good year. And even with all this, they are very, very undervalued compared to where those other mega cap companies are. And for that, I would say that Google is definitely an interesting thing to look into more. So by all means, please do your research on this before you get into anything. I just like to inform and entertain a little bit, but anyway, that's all I have for Google today. Hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't, and I will see everybody in the next video. Thanks for watching.